Over to you, Aseem. So, Aseem, you're currently funded.
Nope.
Is that by design or by default?
Design. I went out to raise funding a couple of times, got a few term sheets, and didn't like the valuation. We've been in money for a fair while at this point in time, and there's something called a chasm. So either you raise really early and give a bucket load of equity, or you start running into people, particularly when you start talking Series A, and they'll start talking about valuations that are multiple of revenue. And most of the time when you're in the chasm, it doesn't make sense because you're losing equity at the seed level, whereas you're already an operational business that is in, cash flow is happening, et cetera. And so you basically continue to grow. So one of the reasons we pivoted to the DoD last year is that's an excellent way to, at least in the US, get various ways of investments. SBA loans are a great idea too. And this was my second go around. The term sheet that we got in the first one was, the equity deal was probably not one I would do again. So it makes a difference what you want to do, where you want to go. We chose at the beginning to actually self-fund at what would have been the seed round.
Mm-hmm. Interesting. You spoke about valuation is a factor of your MRR or ARR. For a software company like yours in the US, what's the X factor? If your ARR is, let's say, X, what valuation are people looking at in the US at the moment for deep tech company like yours?
I think this is where you start getting into how well you know the investor, and how desperate you are for money. And your valuation is a variable range that can range from, I've known people to take 3x their valuation, their MRR, ARR actually, as the valuation. And you hear, these miracle stories of companies in Silicon Valley that get 20x or even higher. There's a lot more factors that come into play. What's your current growth rate, right? So has your ARR or your MRR, is it growing at 10%, 20%, 30%, 200%? Growing at 200%, you can realistically start looking at a valuation that's significantly higher. You're growing at 30%, you're not going to get that great a valuation. And at the end of the day, there's a lot of factors, and it's the one variable that you're going to get even after you meet a bunch of investors that are interested in investing. You're going to spend a lot of time sort of like thinking through that and deciding whether you actually want to take the money. Of course, many startups founders are in a position where they just have to take the money. So that's a choice you make, right?
Wow, wonderful. Yes. Yes. So what we learned from Aseem is this: you must take money. If you have to take it, you have to take it, right? But a big factor in your valuation is your growth rate. Depending upon you're growing 10x or 20x or 30x month by month or year by year, that's a big factor in your valuation. Also, network that you create for yourself, the people that you're meeting, in how much are you desperate for money, or can you survive for some time? Those are also certain factors which determine your valuation, and not just your monthly recurring revenue or annual recurring revenue. Great. Thank you so